I want to start with the USO and what we saw a little bit earlier this week with the dislocation in the oil markets and how the USO reacted to those dislocations in the oil market. Do you think, in your opinion, what we saw was sort of by design and that the USOs essentially behaved in the way that the ETF was meant to behave, or is there something more fundamentally wrong or some fundamentally there that should have been addressed differently?
Well, first, thanks for having me on. You're totally correct. It's been a busy month and a half in the ETF market, starting with fixed income and just how they're structured now, looking at the energy ETFs or products holistically. You know, but look, to your question, anytime you have a stress market, you know, it starts to show the designs and, you know, the potential how things are brought to the marketplace, things to watch out. And you look at USO and a number of other energy ETPs, I wouldn't classify them as ETFs because they have static amount of shares available, and when that is exhausted, they have to file and create new shares. But in the USO case, it was built to track the underlying futures, so you're not necessarily investing in oil per se, but the future contracts. And then you had some macroeconomic supply issues and oversupply, and Super Tango popped up, and all of a sudden USO is behaving as if the futures are trading at negative. In this case, they were. And so you had some issues around just, one, the ability to create new shares. The ETF or ETP was behaving in that manner, and now you have a lot of supply where the front-month future contract was trading negative, and the remaining curve was behaving in that fashion too.
Reggie, how much of the sell-off do you think was tied to USO simply being too big and therefore not being able to create any more shares? Katie Greifeld of Bloomberg News reported that USO recently held about 1/4 of one U.S. futures contract on the NYMEX.
Well, I think you need to go back and examine the underlying asset class. So, you know, is the outstanding futures, is it too large for the marketplace to absorb? Is the number of market participants not large enough to handle the shocks of movement? You know, I think it really comes down to, you know, fundamentally, there's just too much oil in the global marketplace and no place to store it, and then you had contango because of that. So I don't think necessarily it is the ETP USO was too large, and then how the rule set around how the ETP rolls their futures from month to month, and then how the marketplace behaved around that. So I think there's a number of input factors here. You know, I know USO in particular likes to be thought of in a negative light by the pundits, but let's just go back to how it was designed and what it was intended to do.
I'm curious, Reggie, just not just with regards to USO, but really the broader ETF and ETP space. Do you think that what these products are invested in, and more importantly, how they invest, how they balance out and rebalance from time to time, that's transparent enough? Because there was a lot of anecdotal reports about the proverbial retail investors, the mom and pop investors who seemed confused as to what was actually in this particular ETF, what they were actually buying and what they were exposed to. And we sort of saw the same issue arise back during Volmageddon, where you had folks piled into those volatility ETFs that didn't seem to understand what maybe they had bought into.
Well, you know, investor education is a big component in looking at exchange-traded products overall. I do agree with you that education is important. You know, I don't know, I can't characterize if mom and pop retail understood what they were buying. I would say that there's a lot of disclosures in the documents leading up to it, and then even on most retail platforms, there's special buttons and additional paperwork you have to fill out in order to trade, you know, some of the inverse leverage and some of the ETP products. So I think that there's enough education out there for someone to get a hold of and say, look, you know, this is what is invested in. Here's how it behaves. I think more importantly, you know, and what I'm looking at, and there's quite a bit of chatter in the professional circles of the CME's decision to allow a negative future contract and then negative option. So I think there's some concern out there around investor protection, and unlimited liability risk. If you're a holder of a future or an option now. So I think that overall we should be looking at large-scale investment protection around the whole sector, not just the ETP, but in futures and options, and then how that was come to about going forward. Mm-hmm. So largely, I know ETFs or ETPs are largely looked at as instruments of potential volatility caps, and I think that is a misnomer and unfortunate. But look at it this way. If you look at energy ETFs, they're traded in a specific commodity, and when that commodity starts being stressed one way or another, you're going to have some reactions to that.
Well, by actively shifting its mix of contracts, not once but twice, USO is really kind of no longer a passive product. It's actually become more active. Reggie, do you think this is a permanent shift, and what does it say about other passive funds that track commodity futures?
Well, look, I think they definitely roll their futures. They have public disclosures about when the mix of futures they use, front month, the second month, third month, and out. And in USO's case, they've been filing 8Ks, seems like every day, to announce different adjustments. But I think the managers of that complexes is looking at the reality that the front month is trading negative, and you now had the ability to go negative. So someone had the ability to actually not just lose their investment, but owe. And so that ETP was following that. So it's really a special case. But there's a number of ETPs, inverse leverage, USO, DBO. They all have different structures centered around futures. And so someone investing in these products need to understand how the futures markets work, its regulation, and then once you understand that, how the ETPs are structured. It's very important.
Reggie, well, real quickly, we only have about a minute left. I'm curious to get your take on just some of the market-making activity that goes on behind the scenes of these products. Do you think that the regulatory environment, the way it's set up, is enough to allow for a fluid sort of price matching between buyer and seller? Does something more need to be done?
Well, look, I'm a big proponent of harmonization of regulatory oversight between the SEC, NFA, CFTC. You got to get everyone on the same page, and I think sometimes there needs to be harmonization around there. But from the ETF market-making standpoint, I know the ecosystem is pretty robust, and there's enough intelligence out there to handle the capacity. And I think investors have enough protections from an ETF perspective, what to expect. But largely, we're still in an environment of lessons learned, and we'll look back at this episode and figure out some empirical data and look for some refinement. But where my focus is around the negative contracts for futures, and now negative strike options in options, and what that's going to entail for the little guy as they're investing in these products.